Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a very happy Friday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So yesterday I came across an article by CNN talking about an uptick in available 0% down loans. And I put out a video last week talking about this, so I was immediately interested. And the basic premise of the title, at least, is true. There are more available 0% down loans. But as I read through the article, I found myself disagreeing with a lot of parts. And I wanted to kind of explain my thoughts on these types of loans and what I disagree with the article. So the primary loan that they're talking about in this article is one that I did a short on recently, and I mentioned in my video on different options for 0% down, and that is the conventional 0% down loan, where if you are buying less than a $500,000 house and you are a first-time home buyer, you can qualify for a second loan that is repayable to cover the remaining 3% of what would normally be your down payment. This is a loan program that is offered by United Wholesale Mortgage, which is the #1 wholesale lender in the country, and that may be why they're focusing on it, because they just released it. However, it is not at all the only 0% down loan option, as the article kind of makes it seem. There's always the VA and USDA options. Those have been around since the 40s, and there are other both local and national down payment assistance programs widely available. The other one I mentioned in my video last week is an FHA product, where you can finance the normal 3.5% down payments in a forgivable second lien, meaning if you make 6 on-time payments, you do not have to pay it back like you do with the UWM conventional one. And so in this article, they bring up multiple so-called experts to talk about this program in particular and essentially compare this program to subprime mortgages that were around leading up to the financial crisis of 2008. And that's where I have an issue here is, for one thing, like I said, there are lots of different 0% down programs available. And so unless you're painting all of them as bad loans and risky loans, there's nothing unique about this particular one. One person mentioned like understanding the details, and I agree with that. Like if a loan officer is saying, this is a forgivable down payment assistance program, so it's repayable, obviously that's doing disservice to the consumer and frankly loan fraud. But as long as it's being explained, there's really no difference between this program and VA or USDA loans. And if you're thinking the default rate will go up for just because you put 0% down, I would suggest looking at FHA versus VA default rates. FHA is a minimum of 3.5% down. And in the third quarter of last year, the FHA default rate was almost 3 times that of VA. So just the amount that you put down is not by itself going to determine how likely you are to default on a loan or end up underwater. I've said many times before on other videos that in any real estate purchase, unless your sole purpose all along is to flip the property, do immediate rehab and sell it for profit, any long-term investment, you need to hold it at least 5 to 7 years for it to be a profitable venture. Anything less than that, and you're kind of gambling on appreciation. So I do agree that 0% down puts you at a greater risk of ending up underwater if you have to sell within 1 or 2 years, but it's not that much different than if you're putting 3 or 3.5% down. If you haven't really paid down your mortgage, which after 1 or 2 years you're really not because of amortization. You're also putting yourself at risk to market fluctuations. The shorter amount of time you have a home, the less likely it is for appreciation to work in your favor. If that's the case, and you're only owning a home 1 or 2 years before you have to sell, you're probably going to lose money no matter how much you put down. That's a lender and a real estate agent's job, to prepare the client for that reality, that you want to have a plan to own and hold on to the property no matter what for at least 5 to 7 years. The other issue I have with this comparison is that pre-2008, these subprime mortgages, the lending standards were absolutely trash. Like, you could buy a home with terrible credit or no credit, no documentable income. Like, the underwriting process was a joke. Now, for any loan, even a non-QM loan, something where it is, you don't need to qualify income, there are loans like that now available. However, the underwriting standards, even for those, are dramatically higher than anything subprime. So that's the biggest false equivocation here, in my opinion. Ultimately, to me, this is kind of a fear-mongering piece. They do, at the very end of the article, bring up that lending standards are higher now, but they end the article on a note of pessimism. If you're making less than 80% of the median income, you're more likely to be affected by prices going down, which is probably true, but none of these programs that I'm talking about, the UWM program, USDA, or FHA, have anything to do with or have any requirements that you're making less than 80% of the median income. So I don't know why that particular metric was thrown out. Certainly understand why an article like this was put out. Fear-mongering does create buzz and interest, and with interest rates staying high, it's a negative time, and this is just fuel to the fire of pessimism. So I understand why they do it, but I think it is completely off base, and until we do see a real change in underwriting standards to regress to the 2008 subprime levels, I am utterly confident that there's not going to be this dramatic uptick in mortgage defaults like articles like this are making it seem like there will be. As always, if you have any questions or comments, shoot them below, or feel free to call, text, or email me. But thanks for tuning into this video, and I'll see you next time.